Hi, and welcome to the Dish on Divorce. I'm Jennifer Barkin. And today with me, I have my guest, Jenny Bartlett. And Jenny, tell the viewers what you do and where you work.
Thanks, Jennifer. My name is Jenny Bartlett, and I work for Home Equity Bank, and we are the company that offers the CHIP reverse mortgage, which is a product for consumers age 55 and older. We only work with people 55 and older. We only offer one specific type of lending, and it is the reverse mortgage. And what that is a mortgage that you don't have to make payments on. So it's a little more conservative than, let's say, if you went to a traditional bank, you wouldn't be able to borrow up to 90% of the value of your home. The maximum is 55% of the value of your home. And it is based on your age. So the older you are, the higher loan to value against your house you can borrow. So we kind of use actuarial tables, kind of like a life insurance company would, to make sure that you never have equity in your home because you're not making payments. Customers can make payments if they want to, but 95% of our customers choose not to because it helps with their cash flow situation. And we qualify you based on your age, your gender, and the location and type of home and the value of your home. So income isn't really a qualifying consideration for us, neither is credit. So, I find that I wind up helping. Half of my customers are in situations where they just wouldn't qualify at a standard bank because of income levels, either living on pension. Half of Canadians don't have a company pension. So when you go into retirement, if you don't have a really big nest egg saved, you might not be able to qualify for traditional financing at one of the big 5 banks, let's say. And that's where we come in. We can certainly help you with that. And if you are a customer that wanted to make payments, you can, and you can set the payments that you choose to make.
So sometimes when people get divorced and then there's that property settlement, et cetera, and referred to these days when people are a little bit older as the gray divorce.
Yeah.
Are you seeing a lot of my clients?
I am. I'd never heard the term until I came to work for Home Equity Bank. I've been in the lending industry for 27 years, and I'd never heard about it or bothered researching it until then. But yeah, about 1 in 10 clients that I work with are actually going through gray divorce, or I prefer silver separation. Sounds kind of nicer. But yeah, it's empty nesters that have decided to move on. And the CHIP can be used as sort of a mediation tool or an equity settlement tool. Because you're going to be qualifying if somebody wanted to keep the home and the other wished to move out, they're going to want to be bought out of their equity in the home. So the one that's staying could choose to take a CHIP reverse mortgage. Doesn't change their cash flow position, because if your home was paid off, you weren't making any mortgage payments, you still aren't making any mortgage payments. Your equity is equal now, so you still have your equal equity position, but now the leaving partner has their equal equity position that they can take and use for a down payment on a new home for themselves or purchase outright in cash. But what most of our customers will do is they'll use that money for a down payment and then purchase another home and take a CHIP as well on their new home. So they're getting into a nicer home or a fairly equal home, but not having to make, and still building equity. So now they're just living separately and building their equity separately, but not changing their real financial position in regards to cash flow. It's kind of hard to explain, but I do have, I have a slide.
I understand it.
You understand
it. So simply the way I'm understanding is, I'm just going to give an easy number. If I have a house that's $500,000 and I've been in this long-term marriage, let's say, and we're splitting up, and there's no existing mortgage on this house. I'm just making it easy. But now I decided I want to stay in this $500,000 house that I share with my partner, husband, who's now going to be my ex-partner or ex-husband. But of this 500, he's entitled to 250,000. Well, where am I going to come up with $250,000 cash I'd come to you then and say, hey, I need to come up with 250. And you might say,
And I might say, first thing I would ask you is, are you 55 or older, right? And then we base the amount that you borrow on your age and the value of your home. You might qualify for that full 50%. If you were closer to your 70s, yes, you would qualify for 50 or 55% to take out. If you were under 70, you'd qualify for a little bit less, somewhere between 30 and the 50%. But you can always do a second mortgage in behind. So it would reduce the mortgage payments. There's ways to do it. And that's why, I usually suggest that customers call me directly. I can help work out their situation and tell them what they'd be looking at from a cash flow position, and give them a quick quote so they'd know how much they would qualify for. So yeah, if you were dealing with customers in their 70s, and yes, I do see a fair number of those. I've had people in, the oldest I've had so far was 86. That called, and it was that situation. One of them wanted to stay in the home and the other wanted to move on.
86?
86, and yeah, that person did
decide to get divorced at 86. I guess it was really that bad at that point. Right? You would think like, but who knows? I don't know.
They only have so much more time left and just want to enjoy it, I guess, or just be on their own, whatever the situation. But yeah, we can usually help. It's not always as much money as the customer is looking for if they are a younger borrower. Younger to us is under 70. Okay, so if you're under 70, you're probably going to qualify for somewhere between 35 and 50% against the value of your home. But there are other ways.
Well, this is my happy thought of the day, listening to you all of a sudden. Well, I'm nowhere close to 70. I feel it a lot of days, but I'm really nowhere close to 70. So I'm feeling just like a baby.
Yeah, I know. Everybody, yeah, exactly.
I've time to get a chip reverse mortgage because I am over 55, but now I'm like a baby in your world.
You are, yeah. So yeah, so for yourself, you would probably be able to lend about 35% against the value of your home. So for your situation, you could either take a second mortgage in behind for that other 15% that was needed, which would have smaller payments than if you were to go to a traditional bank and try to get 50% financing. Okay. Some of the questions that we get asked as well about the CHIP, there's a lot of information out there about reverse mortgages, but unfortunately for Canadians, a lot of the information, if you look it up online, the first things that pop up are information from the USA. And they run
the American infomercials.
Yeah, they're
and I forget, like they usually have some celebrity spokespeople.
They've got Tom Selleck on there right now, and yeah, he appeals to a lot of people. But their banking system is a lot different from ours. We are a Schedule I bank, just like any of the other big 5 banks, and we answer to the superintendent of financial institutions. So we're run just like a normal bank. It's just that we offer one product. So the things that customers ask us most is, do they retain title to their home? Yes, you do. Just like a regular mortgage, any other mortgage you would get in Canada, you retain title to your home. You're just registering a mortgage against it. The reverse part is that instead of making payments and paying your balance down over time, you're letting the interest accrue over time. So the balance will go up over time. But what a lot of people, the balance will go over time. Just like you had a line of credit and never made a payment on a line of credit or a credit card, the balance goes up over time. It would be the same sort of situation. You can make payments if you wanted to, but you don't have to. But what a lot of people forget is that your home value is going up over time as well. So you've got an asset that's growing at 100% of its current value. So if you're getting, your house is going up 5, 6, 7% a year, it's going up on that 100% of the value of your home, where your mortgage balance, your CHIP mortgage balance, is just going up on maximum 55% of the value of your home. People ask us about our interest rates. They think our interest rates are very high. This is what's in their mind, right? They really aren't. It's really not much different than an unsecured line of credit or a posted bank rate. And this is because we're self-funded. So, and it takes about 12 years before we actually see a return as a company on any mortgage that we do, because customers aren't making payments along the way. So there is risk. So our rates are a little bit higher than you would see at a traditional bank, but they're nowhere near as high as a private lender would be. And there's really no income or credit qualification criteria. So when you're getting into that sort of situation, where you don't qualify, maybe your debt servicing ratio, and you'll hear that from your mortgage broker. That's where the money coming in versus the money going out. If it's more than 40%, you're not going to get approved most likely by a traditional lender. So that's where we can come in and help as well, because we limit how much you can borrow. So what other things?
And like you said, the rate is a lot less
Yeah.
still than often that private lender. You know, when I think of that private lender and I'm driving around my residential neighborhood and on the post, there's sometimes like these photocopy signs and they say, need a second mortgage, need a third mortgage, call whoever. And if you do call whoever, the rates are exorbitant, right?
They're usually around 12% is typically what we see out there in the marketplace. So, I mean, you can around, but that's people's private money. That would be like me lending it to you out of my retirement savings plan and saying, okay, I'm trusting that you're going to pay this back. I'm going to want a higher return for that risk, right? Because these are it's a private mortgage. So that sort of leads me to, you know, another question that customers ask us too, you know, with the balance going up over time, will I have any equity left in my home, right? Because the balance does increase. So we sort of talked about, yes, the value of your home increases as well, but we offer a no negative equity guarantee. And that's something that's very different from the USA as well. So if your home value were to drop to zero, it's not likely to happen. It did, and you had a chip balance of, let's say, $200,000 that you had borrowed against your home with interest, we will never ask for more than the market value of your home when it's sold. So that's a risk that we're taking as well as a company, and that is in writing. We give that to all of our customers in our commitment letters, and that's a very unique thing and something you can feel good about. And actually, it's over 99% of our customers still have at least 50% equity in their home at the time they either choose to sell or pass away. So there's always something left for the beneficiaries. Yeah, it's really one of my favorite stories. He's not divorced, but he is a single gentleman living alone. He's 102. He'll be turning 103 this year if he makes it. But every year he refinances his chip. He's never borrowing more than 55% of the value of his home, so he's still leaving money to his estate. And he uses that money so that he can stay in his home and have home health care brought in. And that's specifically what he uses it for, because he does not want to go to a retirement home. So there's
I don't blame him.
Great uses.
Especially in COVID.
Especially in COVID. Yeah. I don't know if he's going to make it to renew. I have no idea because, you know, privacy laws and everything. But yeah, every year it's kind of a neat thing. So that's something else too. You know, if you were borrowing today for a younger borrower, that doesn't mean that you're set at that 35% limit forever. You can refinance a chip. So as you get older, you qualify for a higher loan to value against your home, and your home value has gone up, so you qualify for a higher limit. So most of our customers do wind up refinancing within 5 years of taking a chip to get the higher limit.
Do they have to break the original chip like in a traditional bank mortgage? If I want to break it, let's say for a lower interest rate, that I pay a penalty.
Right. Well,
or can I just age and come back to you and say, okay, so I can only get this much before because I was 55. Now I'm 65. Is there a penalty?
In the first three, we have an open product that has absolutely no penalties. You could take it today and pay it out tomorrow with no penalty. CHIP is a lifetime approval. So in the first 3 years of your CHIP, whether you took a 1-year term, 3-year, or a 5-year term, there would be a penalty in the first 3 years, but that's only if you were to pay it out, go rent somewhere and never replace your CHIP mortgage. If you were for a higher limit, often there wouldn't be much of a penalty payable in the first 3 years, but we usually suggest waiting more than 3 years to do the refinance. After that, even if you're in the middle of a term, you can refinance because our terms don't work like traditional banks. They're just an interest rate set period is what we call it, rather than a term. So yes, you can break it in the middle of your term and refinance. Yeah.
And what happens if somebody has an existing mortgage on their house? Can they add a CHIP mortgage? Or do you have to disperse the original mortgage?
Yeah. We'd have to
and then get the CHIP mortgage.
That's exactly, yeah. We'd have to pay out their first mortgage. So there has to be enough funds to do that. And then anything that was left over, they decide whether they want to take it or leave it sitting there available for the future. Yeah.
Okay.
A first position mortgage.
So If viewers want to learn more, they want to contact you, where should they go? How do they find you?
My direct phone number, it's a 1-877 number. Do you want me to just give it now? It's 877-842-2447. So it's 877-842-CHIP. My name's Jenny. You can work with me directly, or you could call your mortgage broker, and they can help you with the application as well. We have people like me all over the country that work locally with mortgage brokers, and we help them with their deals, and we will work directly with their customers rather than, so you've got a face to the name and you're dealing with the same person. It's, yeah, we try to keep it friendly.
Awesome.
Yeah.
Well, thank you for coming on the show. I learned a lot. I'm sure my viewers did as well. And enjoy the rest of your weekend. I'm Jennifer Barkin, and thank you for joining me on The Dish on Divorce.